Hi, folks. Certified tax specialist and best-selling author Navy Dowdy here. One of the things we see in the news almost every day is something about the inverted yield curve. Well, what on earth is that? Why do you even care? All that means is that the long-term interest rates are lower than the short-term interest rates. Now, normally, that wouldn't be true, would it? If you're going to lend money out for 30 years, you would probably expect to get more interest than if you're going to lend it out for 1 year. But on occasion, that doesn't happen. The short-term rates are higher. Well, how does that even happen? Well, first of all, let's talk about interest rates. What causes interest rates? Why are they what they are? Well, the long-term interest rates are actually not set by anybody. They're set by the bond buyers. People go to buy bonds. Let's take an example, 30-year United States Treasury bond. And bonds are denominated in $1,000 increments. So let's say the U.S. government wants to borrow some money, and they have an auction. They'll say, we're going to pay you, let's just say, $40 per year for the next 30 years on this $1,000 bond. Well, that would be 4%. $40 divided by 1,000 is 4%. Well, suppose people say we're not going to pay $1,000 for that bond. We'll only pay $900. And if the government sells that bond at $900, now you have $40 a year divided by 900. It's about 4.4%. Now, it's a little more complicated than that, of course, because at the end of 30 years, the whole $1,000 will get paid off. So the return is just slightly higher, but you get the idea. Those rates, the long-term rates, are set by the bond buyers. Well, what about the short-term rates, like the one-year Treasury rate? The one-year rate is set by the Federal Reserve. They just declare a rate. And on occasion, they declare a rate that is higher than the long-term rate. That's the case right now. Short-term rates are higher. Well, why is that important? So far in history, almost all of the time that the short-term rates have been higher than the long-term rates, it's been very bad for the economy. At this time, both long-term rates and short-term rates are higher than they were a year ago. And that presages and actually is causing a slowdown in everything in the economy. Higher interest rates mean less projects can be done, and it just costs companies and people more to do things. And so less economic activity occurs. So for instance, take a look at this. Let's say a couple of years ago, if you bought a home and you borrowed $500,000 at 2% interest, let's just say for 15 years, what would it cost you? Well, I calculate it here on my trusty HP 12C calculator. You would have had to pay for $500,000 loan, 2% interest for 15 years, $32.17 per month, $500,000, 2% interest for 15 years, and then the loan would have been paid off. Well, what about now? Let's say now you had to pay 6% for that same loan. It would cost you $42.19 per month, over $1,000 higher. And why is that important? Because a lot less people can pay $42.19 than can pay $32.17. So you just wiped a whole bunch of home buyers out of the market. And then on top of that, of course, when you have higher interest rates, it coincides with higher inflation. So you have increased property taxes, increased utilities, increased operating costs, increased food, everything increases. So as I'm recording this, mortgage applications are down a whopping 40%, meaning 40% less people are out buying homes. Talk to any realtor, they'll tell you that's what's happening. And get this, mortgage refinancing are down a whopping 86%. 86% mortgage refinancing. So why do people refinance their homes? So because this has a ripple effect to everything in the economy. Housing is almost a fifth of our whole economy. If refinancing, most of it goes to doing remodeling projects, putting on decks, new appliances, things like that. Well, that all slows down. 86% of that has now stopped. So higher interest rates and higher inflation cause a slowdown in everything in the economy. And so far in history, most of the time that you have higher short-term rates than long-term rates, it predicts very bad things coming. Those of you that have been watching this channel for a while know that I've been talking about this for several years. I sketched this ultimate financial tsunami, my 3 coming financial tidal waves, out on a napkin at a conference I was in 2017 in New Zealand early in the year. And, you know, I was hoping those things weren't going to be true, but it appears that they are true, and they are coming. So what's the answer to this? It's always going to be a process, not some product somebody wants to sell you. It's a process. Years ago, I developed in my on tax family wealth private family office my Smiling Retiree process. It's a 9-step process. If you want to get a copy of this and a little training that goes along with it, click the link below and I will get you a copy. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.